Against the backdrop of a raging COVID epidemic and a quite visceral Black Lives Matter movement, Abroad While Black was born. Our goal was to highlight Black perspectives from all over the world. It was our way of proving there are other ways to live, other places to be successful, and different cultures that embrace our Blackness. In 2020, the Abroad While Black team created dozens of responsive hot takes and thoughtful interviews covering topics ranging from current events, business opportunities, dating, and life-changing moments. In 2021, our co-hosts Cordy and Sean aim to share more success stories, more productive introspection, and most importantly, how to relocate to a place that truly values what you offer the world. Abroad While Black is more than a show. This is a social experiment hell-bent on discovering new ways to secure the bag and live our best lives. Join the Abroad While Black squad. Hello, Abroad While Black squad. We're back together again. My name is Sean Burrows. I am the CEO of Burrows Enterprises and the co-founder of Aggressive for Good. My goal in life is to build an economic bridge between Africa and her diaspora. I focus on operations, tech, and investment. So, if you have been following up on what I've been putting down, you've noticed that more recently I've shifted away from doing the interviews with people from all over the world. Now, we've had some amazing interviews, but the thing is, I wanted to get past the surface level of just interviewing and getting feedback and positioning people. What I wanted to do is position people so they're able to, hear of these opportunities, hear what people are working on, and also be able to meet them at a point where they can add value to what they're doing. And to do that, you need a strong operational foundation. Again, I told you I focus on operations because I felt like it's helped me in business, but it's also helped me in life. Understanding how to put together processes that end up to these positive outcomes that you plan for yourself in life day by day by day is something that does not happen by accident. It happens on purpose. So with that being said, this month we are focused on investment readiness, right? So I know a lot of you all are out there looking for money, and it's not a bad thing. You got to do what you got to do. It's a tough time out there. So you have people who are experiencing really tough times, had a great business, once people are not allowed to actually have human contact, it kind of has different impacts on people's business. Or you have some that have been inspired by what's going on right now and have taken this opportunity to put together a new business idea. So for whoever you are, what we are talking about, again, this entire month, we start our months on the 15th. So for those of you who are getting the newsletters and whatnot, you'll get access to this pretty much in advance and understand everything that's going on. For all of you who are not on the news list, get on the news list. So what we are doing, this is going to be a 3, maybe 17 part series because this thing gets kind of in depth, right? So we're going through the investment readiness. So how I have this broken down is this week we're going to focus on due diligence. Next week we're going to focus on doing market research. You'll find why once you understand due diligence. And then we'll probably round this week off, or depending on what you guys kind of give me feedback on, I may add another one, but the last one is going to be what investors look for. Why am I putting what investors look for last? Primarily because you need to have your stuff together before you start going and looking for other people and start having conversations. You need to be confidently positioned where you are, knowing what you want to do, understanding your business, how it works, how it doesn't work, before you start putting something together and crafting something that would be influenced by your thirst for money. Now, I know you're saying that doesn't make sense, but trust me, you want to make sure that when you're focusing on your business, you're focused on the passion. You never lose sight of that thing that made you want to start that business in the first place. So again, you do your part, you do your homework, you do your research. Again, you're going to reach outside of your borders. You're going to be looking outside of yourself, but you want to be the source of that information first. Let that be the cake. And then whatever you're doing now to attract these investors and whatnot, that will be the icing. And again, we're focusing on due diligence, and the reason why I'm focusing on due diligence is specifically for that reason. There are a lot of investors who are, there are a lot of entrepreneurs who want to start a business based on the fact that they might be able to raise money for it or somebody can come and buy it. If that's you, this may not be your learning module. This may not be your channel. I'm not necessarily for us selling out our businesses, but that's a whole different conversation. I do believe we need to own what we create and put ourselves in a position to be the next Rockefeller or the next Carnegie. But again, whole different conversation. What we are focusing on today is going to be, again, the due diligence process and a part of our 3-part series. So again, due diligence, market research, what investors look for. So when you're getting into this, I think we first have to start off with the obvious. What is due diligence? Due diligence is defined technically as an investigation of a potential investment, such as a stock or a product, to confirm all facts. Meaning, just because you come up to somebody and say, I got a good idea, you should do this, and you write a bunch of numbers on the piece of paper like, hey, you give me $5,000, I can make you $5 million. People are going to do their homework. If you're talking about a smart and savvy investor, they're definitely going to look into your company. And also, you need to make sure that you have a smart and savvy investor. Keep in mind that, I'll say this so many different times today, all money is not good money. What do I mean by all money is not good money? You have, let's say you have a sliding scale. So you have investors that maybe they have a lot going on. Maybe they're giving away a lot of money, different things here. And they're really taking a machine gun approach where they're just throwing money in a bunch of different places and hoping somebody makes it. Then you have investors, which are the ones that you want, that take more of a sniper approach, right? The sniper approach is they're gauging their target. They know exactly who they want. No collateral damage. They're going for this one person to take them down based on certain characteristics or whatever it is, right? So, of course, they're going to do that 20 times, but for each person, they're taking their time. And what you find is when investors are taking this type of approach and spending their time with you, that there's also other support that may come out of them taking that time with you. So also look into the ecosystem of the investor. I mean, again, this is a whole different conversation and understanding what type of people you should take money from. I know most of you are like, I just want to know how to get it from anybody. Be very careful. Again, you want an investor who's going to put their time, energy, and effort into you. You're going to want an investor who does not have competing products. Like if you sell apples and oranges on an Android application, you don't want to go to a company that also sells. An investor that is invested in a company that does the same thing you do. Why is that, you ask? Well, because at some point, one of you has to come out the winner. And it's going to be the one who gets the most resources and the most support. And you don't want to get in a situation where your source of money is looking at you potentially like you ain't it. You want somebody that's going to be all in your corner. You're going to want somebody that has connections to different types of partners, different types of people. Like if you look at who's inside their network, again, if it's a VC, you're looking at there's typically more than there's several people who are investing into a fund. So now you want to look and see like, oh, okay, who are the people that are investing into this fund? Are the people who are investing in this fund or a person or are the people that are within this investor's network? Are they people who could be potential partners, other sources of capital, a knowledge base that can take you to the next level? Those are the type of things that you want to look at when you're looking at your investor. So those are some of the things you should be looking at when it comes to them. Now let's look and see what they're looking at when they look into your company. So I've broken this down into various steps. Just understand this is not a Bible, it's not a law. What we are looking at more or less is what are the things that investors are going to consider. I have it in an order. These things can go out of order, but let's jump right into it. So, well, let me pre-warn you. I'm going to throw some words that you may not know. There's typically, I take notes. I'm actually looking at my notes now to make sure I don't just go off into a tangent. But But so if you want access to the notes, just hit me up in the comment box or join the subscriber list. I'll make all these things available to my community members. If not, yeah, just listen closely. I try to share everything I can whenever I can. So what we're looking at as one of the first things they're going to look at is your market capitalization. So when you hear market, of course, you know market means the area in which you're operating in. That can be used in this case as in the actual internal market, like you're the market, or the whole market, meaning everybody who operates in the same space as you. Then you have capitalization. When you hear capital, just assume it means money. So when you hear market capitalization, you're saying like, how do I or everybody else in my network gets money? Like how are we making money? Where's our money coming from? And that's what it's exploring. So in looking at market capitalization, what investors are trying to do is basically understand just how big the company is. Now, what they do is they calculate the dollar market value of your outstanding shares. What is the dollar market value of your outstanding shares? So I'm going to be very, very surface level with this, but your shares are how you break down the ownership of your company. Also can be considered when they start talking about equity and different things like that. That's what they're talking about. Like, let's look at it like if you look at something being 100%. Let's just say that you have $100 company. If you've broken your $100, when I say your $100 company, meaning the valuation or the value of your company is worth $100. I know we have bigger dreams, right? But we're just starting off. Some of you all haven't started at all. You should be hoping and praying for a $100 company. Other conversation. But what we're saying is that $100 company, if you, let's say, break your company down into 100 pieces, that means that at the dollar rate market value or the dollar rate market value, what you're looking at is $1 per share. That's how it breaks down. That's the simple math. So what they're trying to say is how big is the company and how much is it worth when we're talking about market capitalization. It's a question that says that how much of this company is available for me to buy and what is that worth? And again, I've touched on the dollar market value. Now let's say what the outstanding shares are. So outstanding shares are shares that are available to be purchased. Now there's so many different classifications they have on stock. So again, I'm going to try to keep it really simple, not getting into like restricted shares. There's common stock. There's like all these different terms. They use a lot of $20 words to explain to you a $5 problem, right? So let's say that outstanding shares are the shares that you have that are available to be bought or that have been bought by people who are, let's say, outside of your initial founding company. So you have your shares that are for your employees, your founders, those type of things. And there are other different special classifications. Those are probably the most common ones. And then you have the ones that you're going to basically use to get money through selling pieces of your company to raise money. Selling pieces of your company to raise money is taking investment and giving people equity or shares. So I know I'm being very silly, stupid, simple, but trust me, I have to be repetitive on this one because when I start jumping into this stuff and it starts sounding French, you'll get me. I find that there's a lot of math when you're doing your due diligence. You have to know your numbers. And what I find is that math builds upon itself. So what happens with math, and this happens with many other things too, if you don't understand the foundation, the things that come after don't make sense. So with math and with other things in life, if I find myself in a space where I don't understand something, I try to go back and back and back and back till I realize or get to something that I recognize or something I do understand, and I start over from there. Pro tip. So with that being said, the investor with market capitalization, the investor wants to know, is there enough value left in the company for them to get returns? So how would you capitalize this? Let's say, again, $100 company. broken down into $100 pieces, which is $1 per share. Let's say that you've given $30 of your $100 company to yourself and your employees. That means there's 70% left. That basically means that there's $70. So this metric, it's just very simple, but this measurement means more as we continue down the path. So again, it's saying like, okay, how much for the company that's available for sale, how much of it is left? How much is that worth? That's market capitalization. But again, overall, it's just how much is your company worth? The second part an investor is going to look at, and this is where we start getting into the math. They're going to look at your revenue and your margin trends, right? So again, investors understand that all money is not good money. And the investigation here is going to tell how your money was made. How stable is your money? How safe is your money? The way that it's coming in, the way that you're generating it. That's what they're looking at. So for bigger companies and different things, or if you're in a bigger market, investors will typically look online to get financial data, but we're just starting out. So you basically have to create those numbers that they would typically go online for. For those of you who are creating businesses or doing businesses in developing markets, one of the major issues, when I say developing markets, you have the South Americas, you have your corners of Eastern Europe, Asia, Africa. These are the different places where they're saying they're developing. The US, the UK, Germany, places like this are what you would call developed. So again, the reason why I go through that is to say that big data is just not available oftentimes. There's just not the mechanisms, there's just not the sophistication of the market to have situations where people are really just kind of tracking these things in the way that you would want them to be able to store data for everybody to feed off of. So again, this is part of the reason why data is the new oil. If there were better data tracking and collection to get big data and give you overall insight into the market, that would make investors more comfortable. You would see higher valuations. Again, valuation is how much is your company actually worth. But since this information is not available, you, the company or the entrepreneur, you have to be on top of your numbers. You have to be able to communicate these things effectively and position yourself as a thought leader in the conversation, especially if you're talking to investors outside of the African continent, because there will be zero trust. And again, outside of these developing countries, there's going to be zero trust if you're going for developed country money. So basically what we're going to get into is a bunch of ratios. When you hear ratio, just keep in mind that they're trying to figure out the balance of something. Is there too much of this or not enough of that? That's typically what they're looking for. So one of the first things they're looking for when they're analyzing your revenue and your margins, your trends. So when we say margins are when you take how much you made and you subtract how much it cost you to make it. That's your margin, right? And your trends, when we say margin trends, we're looking at, all right, so you've been selling this thing for 2 years. What have your margins typically been over this 1 or 2 years? So again, one of the ratios that they use typically or commonly is one called price to sales ratio. Price to sales ratio. That is dividing the company's market capitalization by its total sales over a designated period of time. So again, you're going to take how much your company is worth, basically, and divide it by how much total sales you've made, let's say, over a year. Typically, you can use typically they're looking for years or as much financial data that you have, basically. So if you've been in operation for 5 years, provide them with 5 years. Once you start getting to 10 years, honestly, once you're at that point, you can stop at probably 5 to 10 years, somewhere in there. But again, if you're a company that's less than 5 years old, you're basically doing this over that entire period of time, meaning you want to have your price to sales ratio over the entire time your business has been existing and allow the investor to pick and choose what periods of time they want to look at. When you're doing this, a low ratio in this situation would say that the stock is undervalued. What does that mean by saying the stock is undervalued? Meaning that if you're saying that this is how much my company is worth, and then you're looking at the sales and you're getting a very low ratio, they're saying that obviously your company should be worth more based on how much sales you have. The individual shares that you are willing to give me should be more based on how much you're selling. That's what this is saying. Now, again, the opposite side is if you have a high ratio. A high ratio meaning if you're saying your company is worth this much money, but your sales are this much, then that means then we're saying like, well, look, your company's not as much it's not worth as much as you say it is, right? So that's what this price to sales ratio is saying. It's looking at the price of what you're selling, how much has come in, and then using that to kind of give insight into how much that company is worth. So one of the downsides of using the price to sales ratio is that it doesn't take into account the earnings. It just doesn't take, there's just certain things it doesn't take into account. So of course, that's why investors use multiple ratios. So of course, the next one is going to be the price to earnings ratio. This measures the current share price, meaning again, if you've broken your $100 company into 100 pieces, leaving you with $1 per share, it's saying how much is that share compared to per share earnings. I know this gets kind of confusing, but let me break this down. This compares the price you charge per share by the profit each share is earning. So let's say the question that you're going to be answering basically with this one is, how much will the investors make per share? So they use something that's called the EPS to calculate it. EPS is earnings per share, right? So if you want to say that my share cost us $1, how much is that share making? You want to determine what are you earning per share. You know what I'm saying? So it's kind of common sense, even just looking at it and going through my notes and even, looking at all these things over so many different times. Like, I still have to be very deliberate in my thought process. This is not one of those things. Again, you guys need to take this really serious. When you're playing around with these ratios and playing around with this math, I can't be distracted. I have to be really focused and understand, because there's a lot of little small moving parts. There's a lot of homework you have to do to get to the point where you start putting these different things together. This is why I can't say enough. When you start coming across entrepreneurs who have not separated their business account from their personal account, different things like that. But that one in particular, because when you have all of these things in there, it's almost impossible. It's almost impossible to be able to track any of these type of things an investor would ask you for. And you really have to understand as well, investors like your story. They like something that has grown over time, right? So like, it's okay if you started small. You understand what I'm saying? But you can't let it be okay. You can't communicate the okayness within that small starter or whatever, like so many people start, if you haven't tracked it, if you haven't put things together. You may have a company that you've been running for 10 years and you can tell an amazing story of ups and downs and what you've learned to be able to say, like, this is why you should invest in me. But if they were to look into your books and different things like that, then it would look crazy. It wouldn't represent you well. So now you're forced to say, like, I don't know what happened. I'm not going to mention those previous 10 years, but here's this brand new company. You see what I'm there? Just be very diligent with tracking and how you take care of the money and the earnings and the profits and the different things that come into your company. Just the major thing that you can do is, number one, open a separate banking account for your business. I don't care if it's a personal one, private names, no names, just have a separate thing for your business where you can just track what's coming in and what's coming out. All the expenditures and whatnot should be attributed to the business. If you're running low and this is all the money you have, even if you're taking money out, make sure you document it as a loan and be documenting everything. And just make sure you pay your company back or you look silly, right? So again, to take this back, we're looking at price to earnings ratio. And the question you're answering is, how much will investors make per share? They use this model called EPS, which is earnings per share. So we used an example earlier, but what earnings per share is calculated by dividing the profit by the number of shares outstanding. So we know that profit basically is your margin. It is how much you sell your product for minus how much it costs to make it. That's your profit. And then your shares outstanding are, again, outside of the shares that you are holding as special shares for your founders, for your employees, for yourself. The rest of them that you're willing to give to investors are shares outstanding. So the example we used earlier was, you have a $100 company, you've given $30 of your company to your employees, leaving you with 70 shares outstanding. Let's say that you have made in this year, your $100 company made $200 of profit. So, and dividing that $200 of profit by that 70 shares outstanding, you end up with $2.85. So in investor talk, that means they make $1.85 for every share that they owned over the measured period of time, or if it's a year or whatever the case may be. So that's why that's important. They want to know how much money they're going to make, and they can look at a few numbers and already know. So again, if you don't know these things, understand that these investors are coming in, and when they're offering you money, they're offering you this money knowing exactly how much they expect to make from you. I don't care what your pitch deck says, your documents, all these other different things. When they start breaking down your numbers and looking at these things, this is where you start to look like a clown in front of them if you think you can just lie and put things together. Again, I'm not assuming people are lying. I'm just saying that I've met a lot of PowerPoint entrepreneurs. I call PowerPoint entrepreneurs those people where they haven't actually done the business, they haven't moved a muscle, but they want to give me this document and read it, and then after I read this document, I should give them a massive amount of money. It's not how it works, sir. And I can even tell you, even though you haven't worked or done anything, I can look at even the numbers that you give me. Even sometimes the lies that people can tell are easily broken down. So again, let's be serious with it. Let's be focused when you're putting these things together. Because again, a savvy investor, the investor that you want, will look at this and pull your numbers apart. Again, I've said it already. One of the lessons learned here are just keep good records. Just really, really keep good records. In these two areas, or with market capitalization in general, and with the numbers and ratios that they're looking at, they are looking at a company's, they're looking at how stable or how the money comes in. They're looking at like price fluctuations over time. Are you moving your price up and down, doing all these different things? Do you know what you're doing? Are there major swings? Like, is there like a 50% dip in profit in 1 year? Like, what's going on there? They're going to want to ask questions and know what's happening. They're going to review your profit margins to understand if they're generally rising or falling, right? So technically, if it's good or bad, again, all of these things are small pieces that end up in a story. So again, let's say there's a situation where, I've decreased my profit margins. And you would assume maybe that's a bad thing, but if you've increased your volume, then maybe you've made up for anything you would have lost by moving that down. Sometimes people do move their prices down, decreasing their margin, decreasing how much money they make, basically to make more people want to buy it. So there are all these different things where it's not necessarily what the number itself says, it's just what it says from a general story, right? So let's move on to the next one. So the next one we're looking at is competitors and industries. One of the major things an investor is going to look at is your competition. Again, if you're a new company especially, they don't know what you're going to do. They don't know what you're capable of. So what they're going to have to do is look at the entire market to better understand kind of how everybody else is operating. If you're doing something similar to what, I mean, everybody, like, there's no new idea under the sun, right? Even a lot of they're very, very rare. We can look at the craziness that Bitcoin is doing right now. Like, oh my God, a digital currency. It's a digital currency. So yes, blockchain is awesome and it's new. Having this thing online, being anonymous is new. But the underlying thing of what this is it's a currency. And currency has been around since forever. So that's what I'm saying. So even you in your space, what you're doing, there may be some type of intellectual property. There may be there's just some secret sauce, something that you do differently. But it's still not a completely new idea. It's just not. So with that being said, they're going to try to find, no matter how new and different and far out, your investors are going to try to find something that's very similar to what you're doing, that's very close to how you're operating, to be able to say like, okay, if they did this and this company is capable of doing this, this is how much money they can make. This is the type of obstacles they're going to come across. So again, these are the major areas that they're looking at. So again, the goal is to size up the industries you operate in and whom you compete with. So one of the most ridiculous things you can do is go into an investor meeting or have any type of business and not understand truly who your competition is. Just never do that. It will throw off a clown alert to the investor. If you've gone and done all this hard work, obviously you had something good in place. If you met this investor through sending a pitch deck and they responded, don't mess it up. Again, they're probably not even going to respond to your pitch deck if you're not talking something about what the competition is and how you're going to deal with it. So again, some of the things that your investors will do, again, this is harder in developing countries. Well, technically, I can't even say it is harder to do to find the information, but they will, especially within developing countries, kind of the only thing they can do is compare you to what they see as your competition and get as much information as they can from them. Because there's not going to be a lot of historical data. And again, if you know companies like I know companies, they're really not that interested in trying to give away a lot of information about what they're doing for obvious reasons. So again, what investors are going to do is they're probably going to look at like the numbers, the finances, the figures, the margins, or whatever they can for at least 2 to 3 of your competitors, at least. And the reason why, again, is every company is partially defined by its competitors. If you can't find a competitor, find a competitor. There's somebody that by buying your product, they're not going to buy something else. Your product or service should be, if you're smart, solving a problem that something else probably was already solving. People are managing and going through life. So again, how people deal with something may not be a product or a service, but they're dealing with it and you're going to have to compete with that. So if your competition is human nature, do your research on human nature, find out what it is and how you have to compete with that and what you have to do. But there's always a competitor. Again, and what investors are able to see is that just by looking at the major competitor in each one of your lines of business, if there's more than one, they can determine how big the market is for its products. For example, if you're saying that the market is underserved, but company X is doing $12 billion, they know that the market is at least worth $12 billion. And if you're able to put into your marketing plan to say that, oh, I can, by competing with company X in this way, I can cut into 20% of their business. I should have used a better number than 12 billion. But again, they'll be able to say like, okay, this is how much this company is capable of pulling in, right? So, so there's that. So the next step, or the next section I'm going into, is valuation. Now, I'm not going to go too deep into valuation because that is something that it's so important. It's so important, number one. But number two, it's very complicated to do it correctly. There's so many different ways to do it and very intricate ways to do it. That you choosing one way to evaluate your company and your investor choosing one way to evaluate your company may have you having completely different numbers. But the thing that I tell people about valuation is this: if you are the founder of your company, or a key stakeholder in your company, you must know the value of your company. You must know it. You must understand the math. You must go and do that research and do that homework and understand exactly how to evaluate your company. Because what you're going to find is, going forward, if you're trying to raise funds, whether it be through debt or through any number of different things, what the number they're going to be using is what the value of your company is. Like if you're using your company as collateral, well, how much collateral is it? If you're raising money for investment by giving people shares or equity, pieces of your company, then how much are these pieces worth? When I'm giving you this money, what am I getting? You have to know the valuation, because that's going to be the key point that you're going to find yourself negotiating on at all points in time. And yes, you want to have outside help or some professional or whatever come and help you. Yes, but they should be helping you not only understand what your valuation is, but how they arrived at those numbers. Because again, your goal is to understand how. You don't want to have to call somebody or bring somebody in each time, because your valuation is not something that just stands there static. It's dynamic. It's always moving and changing based on the decisions you're making within your business, right? So you don't want to be in a position where your investor is telling you how much your company is worth. You need to be able to get up from the table and walk away if you truly know what the valuation is worth. Because you have to understand, with this negotiation over the value of your company, what they're saying is that when they're giving you money, that they're going to get a certain piece of your company, right? So if they get a certain piece of your company, the lower the value of your company, the more their money gets them. So I've been using this $100 valuation, right? So let's say that you valued your company at $100, right? And you want to sell off 20% of the company to an investor to get things started. So you're looking to raise $20, right? But if you go to the investor and the investor is saying that your company is not worth $100, your company's only worth $50, right? And now they're still standing there with that $20 for your $100 company, saying that if I give you this $20, it's not going to give you 20%. It's going to give that investor like almost 40%. High 30s. You know, they get more value of your company for that money. So again, I'm just giving you that example. Again, I should use better numbers in the future. But again, the idea behind this is just to give you insight into why your value is more important. Your investor is going to want to value your company lower sometimes. Sometimes they want to value it higher when it's time for them to sell after they've invested. But in the beginning, before they put their money in, it benefits the investor to value your company at a lower amount because they can buy more of it for less. So with that being said, there's a lot of numbers dedicated to valuation. I'm actually going to bring in a special guest to help me go through these things with you. But again, there's a long hair somewhere on my nose that's causing it to itch. I know that some people see people playing with their nose a lot and they start thinking things. I don't play like that. I'm not about that life. I'm not. obviously food and beverage industry. I bumped into a lot of people who have, why I'm very sensitive. But anyway, so with that being said, there's a few different ratios, calculations, and different things. So I would say that these are the ones that you should look up for yourself, but also try to look it up for your competitors if possible, just to understand where you are and where your competitors are valued at. Again, if you and your next door neighbor are doing the same business, but your neighbor is able to confidently convince people and say that his company's worth $1,000 and y'all doing the same thing and you saying yours is worth $100, you need to understand what the heck is going on over there, because y'all doing the same thing. So again, I'm just going to give you some of the names, things you can look up. Again, prepare you to maybe get some background knowledge for next week. So some of the ones that they're looking at, there are more. There's the price to earnings to growth ratio, PEG. There's the price to earnings ratio. We've already talked about that one previously. There's growth stock versus a value stock that they're looking at to understand that one, to understand, where you are. Are you something that's going to grow, or are you something that's a blue chip as we stand and just nobody knows but them, right? They're also looking at your price to book ratio, and then they're looking at your net earnings ratio, or just your net earnings, and so many more things. But again, what they're going to do is take note of any large discrepancies that exist between your company and your competitors. At this point, just being honest, it shouldn't be strange if an investor is more interested in your competitors than you at this point. I would say this: don't be jealous, don't get in your feelings, provide them with the information they need. Again, especially if you're working in a developing country with your business, because these type of numbers are not necessarily going to be easily available. So that provides you with an opportunity to be a thought leader in this space and provide information to them, building up the trust and different things like that if the numbers are solid and they make sense. All right? So don't get jelly. Step 5. Or one of the fifth, another section of things that they're going to look at is your management and ownership. I've said so many different times, a major part of what investors are investing in starts with the people. Again, you can have the greatest idea in the world, but if you don't have the people to run it or a plan to get the people in place to run it, you're going to run into some major issues. So again, a major part of this part of the due diligence is they're going to be going through your company, understanding who does what is the experience level of your company. So they're going to be asking questions like, is the company still run by its founders? The people who started the company, are they still there? Or has the management board been shuffled around? This is for some of the bigger companies, but again, is the leadership stable? Is this a stable, consistent, reliable company? As told by the fact that after so many years or months or whatever the case may be, the people that started it are still there. They're looking at the age of the company. Again, if the company has been around longer, there's a bigger chance that the founding members have gone, right? If you look at Facebook, if you look at Apple, like a lot of people didn't know, like Apple, Steve Jobs was actually fired from Apple at one point, right? People don't know that, well, not that people don't know, but there are founding members of Facebook that are no longer with Facebook. So again, this is a company that's been tried and true over time, and now they've proven successful, but all of us ain't Facebook. So what they're looking at is how long have we been around? So sometimes investors look for younger companies. But again, part of the reason why they like younger companies is because everything's still fresh, still new. The team is still together. The original secret sauce is still in the building. They're going to look at the consolidated bios of your top managers to see what kind of broad experiences they have. Like if you're trying to launch an alcohol brand, but the only thing your founders have worked on is makeup and cosmetics, they're going to be like, well, what does this guy know about this? Why is he here? Why should I believe he can run this company? Now, again, sometimes you have opportunities to connect the dots in conversations. Sometimes you don't. But just in general, it's a good idea to have people who have experience in a space be running the company and have that knowledge base. Again, it's not a good sign if people don't. Now, again, your history and different things like that can say that, no, we're good. But outside of that, if you're a newer company, don't make a lot of sense. Again, it's a red flag. Another thing that they're looking at is the shares that are held by the people who own the company. One of the things that they're looking at is that they actually want the founders to have a lot of shares in the company. Why? Does that make sense, right? Why would I want all the shares for myself? Why would I want the founders to have it? No, it's one of those signals that if the founders have a lot of stock in the company, then they think that the company is strong and that it's going to work, and they want as much as that value as possible. So, like, I'm not gonna, if you don't want it, I don't want it. I for dang on sure don't want it. I almost cursed y'all that my country came out trying to protect myself. But yeah, they're going to say, like, all right, do these guys want the company? If you don't want it, I don't want it. So again, the shareholders tend to be best served when the people running the company have a significant stake in the performance. So again, one of the biggest parts of investing is who they're investing in. It's almost sometimes more important than what. Step 6, again, I'm going to touch on this, not go too deep. I did do a financial literacy course. I'm sure you can find it online. I'll try to find it and share that with you. But yes, balance sheet. I would say if you are a company that is operating, and when I say balance sheet, it makes no sense or it sounds like something that you don't really know about. You're not ready for investment at all. And you may need to go and take a better look at how you're setting up the operational structures of your business, especially the financial part. The balance sheet is a very simple, well, it's not, it just depends. Simple is subjective. But it's not a very difficult thing to come up with. And it's something that you should be working on fairly consistently. It should be, if you have an actual business, if you've gone so far as to register your business, there should be a balance sheet lying around. And again, what the balance sheet is, I've just insulted you without even telling you why. The balance sheet basically is to see the overall level of assets and liabilities, meaning the things you own versus the things you owe. You subtract that, right? That's very basic. So again, it's something that you should be keeping track of, period, point blank. So when they're looking at your balance sheet, they're going to be looking at your cash levels. Why are they looking at your cash levels? Because they can also see your debt, and they want to see your cash levels to see how capable are you of paying off that debt. They're also going to look at the amount of long-term debt held by the company. Why is long-term debt relevant? Meaning there's a good and a bad side, right? All debt's not bad debt. All money's not good money, right? So there's two different things to learn from there. But with long-term debt, from a bad perspective, if it's the wrong debt that you're tied into, it means that, like, this is basically securing or locking down a significant amount of capital or whatever amount of capital for a long time. That means that no matter what you do, this certain level of capital is not going to be able to be used to make more money. If you go back to what we were saying about shares, and earnings per share. Earnings per share is saying that for each share that you have, it's going to be able to make this much money. Long-term debt and debt in general is going to pull down on these figures. Again, if I make $100, but I owe $200, and I have to pay $20 a month plus 40% interest and all these other crazy things, you're not able to become profitable. If you're saddled down with the wrong type of long-term debt. Again, it's almost like, buying cars. Like, you're buying something that depreciates. It's technically not a good long-term debt, if you want to consider that long-term. And again, so the other side of debt, Again, there's a part where sometimes debt can be good. Like there's some businesses that are very capital intensive. Businesses that take a lot of that would require a lot of money, a lot of capital, a lot of turnover. If you're in there are just so many different things. Like if you're operating in some of these, like if you're selling beverages, so to speak, beverages like Coke, Pepsi, different things like that, very, very, very low margin, and you have to buy a bunch of it to get it at a good price, right? So you're able to say, like, I have this debt that I've spent to buy all of this product, but technically you can look at my history and see that I'm able to move the product, and then buying it and taking on this debt, it allows me to get the product at a lower price, right? So then somebody might be like, oh, okay, that's good then, right? So just be careful. Don't borrow the wrong money. Again, another thing that they're looking at is the debt to equity ratio. So what is the debt to equity ratio? Is basically calculated by dividing a company's total liability by its shareholder equity. Meaning, what this calculates, or what this helps investors understand, is that if you're making money or if you're just spending money. Again, meaning if you're just taking in a bunch of debt, but you're not making a lot of money, the value of your company is not going up and different things like that, then it just shows that whatever debt that you're taking is not the good type of debt. It's not benefiting you. It's saddling you down. So there's a couple of other ones I'm going to fly through. So you have one area where investors look at is your stock price history. So for some of you who are raising for a second time, so you have so if you're looking at fundraising rounds, typically you have your first round, which is your friends, family, and fools. That's you and the people that are around you that believe in you. The next stage you have is your seed investment. So if you've already taken your seed investment, the next one is going to be Series A, then you have Series B and Series C. So again, if you're publicly traded and doing all of these different things, or if they're just looking at the valuation of your company, let's say if you're not being publicly traded, again, they just want to understand what the value is. Has it been consistently growing up? All of these different things to just kind of understand how your business has been doing. But again, stock prices specifically for the next level, not necessarily you're just starting out. Another one, again, not going to go too much into it, but stock options and dilutions, stock option and dilution. So again, not very complicated, but yeah, again, this is not necessarily for beginners. I just want you to know that these are some of the things that they would look at. In case you're talking to somebody else, you want to know enough to be dangerous and sharp, throw some things around, that might help. The next one is expectations. So the expectations part of what an investor is looking at is kind of a catch-all. And for an investor, it would require a lot of extra digging. So that's why it'd be beneficial for you to be able to, again, position yourself as a thought leader if you are a, entrepreneur or whatever within a developing country. So with expectations, it's varied, but there are just certain things that they're looking at. So to give you a couple of examples, they want to know, like, what are the revenue and profit estimates for the next 2 or 3 years? So again, some financial forecasting. They want to know long-term trends that could be affecting the industry. So let's say if you're in agriculture and this place has droughts every 4 years or whatever, or so, whenever El Nino comes, whatever the case may be, they're going to want to know how these things would impact your numbers and impact your performance. Another thing is, like maybe there's some internal information that would be very helpful to an investor trying to kind of see if they're on the fence. Like they may want company specific information about details like partnerships, joint ventures and things like that. They also want to know about any type of intellectual property. I mean, you don't have to give them, don't give away the secret sauce if you don't have to, or if that's what you would be doing. But again, you want to let them know that, yes, you have intellectual property, something that gives you a competitive advantage, and any other new products or services you want to be launching. So that's what they're looking at to kind of see, like, what do we expect this company to do over time? That's basically what they're trying to answer in that particular line of thought. And the next one is going to be risk. Again, that's the game that investors are playing. They know it's going to be a risk. They know it's going to be a chance they don't get their money back, but they don't want to make a bad investment where it's just pretty much obvious nothing's going to come out of it. So there's certain things that they look for. They want to understand both industry-wide risk, and they also want to understand company-specific ones. So they want to understand like things like, are there any outstanding legal or regulatory matters? Is management making decisions that lead to increase in the company's revenues? Is the company eco-friendly? What kind of results could come from not embracing green initiatives? These type of things. I would say a good investor would want to continuously be playing the devil's advocate. They want to know what are the potential things that can happen. What are some things that they don't want to be blindsided. So what they're basically doing is as much deep diving and understanding of your business and things that could go wrong as possible. Sometimes just pulling things out of thin air. What if you get struck by lightning? Again, if you've heard me speak about this before, this is why it's very important to have an exit strategy when you're putting your company together. They want to know what happens either when you, like, how are you going to get out of this business? How are you going to quit? If they're looking at investing their money in the long term, they don't want a situation where, let's say, if you look at Apple, where, I mean, nobody is going to say Tim Cook is Steve Jobs or compares to him in that way. But Steve Jobs was able to exit the company as the brilliant genius he is, and the company still keeps going. We're shooting this in 4K, 60 frames per second, thanks to this newest iPhone. They should pay me for that. I feel bad now that I said it. Anyway, moving right along. So these are all things that you want to consider. So what we're really talking about in so many different ways is what I'm going to deep dive into next week, which is market research. So why am I jumping into market research next week is because after all the things that I've thrown at you this week to let you know kind of what investors are looking for, next week I want to give you some tools, some tricks, different things you can do to kind of help you find that information. How do you organize that information? I just want to give you the entire process because, again, what I find in operations, what I found in the church is that everybody can tell you the good gospel. Everybody can tell you the 10 Commandments, but they can't necessarily tell you how to pull it off. So I'm going to try to give you details and say, like, you should do market research, but I'm also going to tell you how to do market research. What's an outline you can create that in time that basically you can figure it out for yourself and be able to add things on or do it in your own way, but at least understand what is expected of you when you're doing research in your own market. So with that being said, in honor of my guy who just got out, if you are enjoying this content, please do the shmoney dance on that subscribe button below to get alerts for more of these tutorials. Also, go to burrowsenterprises.com for more learning resources. And please, especially for those who are outside of Lagos, Nigeria, follow me on social media. All of the links are below. I love you guys. I'm always here for you. I look forward to seeing you again next week. Peace.